following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. Thank you for joining us today on 94.1 FM WNBU, as well as cable TV 10 in New Bern, North Carolina. Some of you may be watching us or listening to us over the web. From our website, we welcome you as well, www.dlblain.com. We post the archives copies of the show there, and we welcome comments from all our viewers and listeners wherever you're picking the show up, whether it's today, this week, current, or if you're logging on to the archives and you hear something we talked about a year ago. Let us know what you're thinking. Give us your comments. What you like, what you don't like, some topics that you'd like to hear on the show. We love to talk about things that you want to talk about. Of course, I have things that I like to talk about, but if nobody else wants to hear them, then doesn't make for a good show. So we want to hear what's on your mind. One of the things that's on a lot of people's mind right now is taxes. It's tax time again, and every time this year, taxes kind of come into focus. And as I've said several times on the show, that taxes are so complex today. Maybe if you just go to work and you get a W-2, it's somewhat simple. But as soon as you venture beyond that, it gets very complicated. Even if that's the case, maybe you qualify for the Earned Income Credit. Maybe you have a home mortgage. Maybe you make charitable deductions. Maybe you got a little bit of a investment account. You got a little bit of interest dividends. Maybe you moved. There's just maybe you're divorced and the exemption dependent rules. Maybe you have a family member living in your house. Maybe you have somebody going to college. So you can see all these situations impact on your taxes. And so a lot of people, they say, well, I just go to work and get paid. Well, just about everything today impacts on the taxes, and it's become extremely unwieldy. As most people know, I'm a proponent of the fair tax or some sort of flat consumption tax. I don't know if that's a reality, but maybe we'll get into that a little bit today. But I want to start off with capital gains, seeing as how we're in the investment industry. This is something, my firm, we manage our clients' money. It's something that we spend a lot of time on is tax optimization. And when you have investing accounts, a lot of you maybe have a 401k or IRAs. Some of you have what's called a taxable brokerage account, a regular account that has money that you made. It was not put in a 401k or IRA. You just saved it and invested it. That's called a brokerage account, usually titled in an individual or a joint name. And the income and capital gains from that account is taxable each year, depending on the type of income that you made in that account and whether it was short-term or long-term. Money that is made every year in a 401k is not taxable. And so we have strategies when you're no longer working there, or when you turn 70 and a half, you have to take money out of IRAs and 401ks. There's a whole set of strategies on how to get that out efficiently and tax effectively. It plays into what we're talking about here. So I wanted to spend some time talking about the capital gains. If you have a large taxable account, maybe you inherited some money that was not an IRA, maybe you sold a business, maybe you just saved a lot of money over the years and have a taxable account. The capital gains tax is once again become more confusing than it was. Whenever there's a tax law change, believe me, there's in 30, 40 years, there's been no tax simplification. Okay, so under the old system, there was essentially two rates, 0% and 15% capital gains rate. Now, first of all, let me back up. What is capital gains? A capital gain is when you purchase something, and for this example, we'll use a stock or a mutual fund. Let's say you bought mutual fund XYZ and you paid $20 a share. And at the end of the year, it went up and it was now worth $25 a share, but you didn't sell it, so it just went up on paper. There's no tax owed on that. But let's say that you're saving for college, you bought this mutual fund for $20 a share, and 5 years from now, your son or daughter is going to college, and so you sell it, and you sell it for $30 a share. Well, the difference between what you paid, $20, and what you sold it for, $30, that $10 is a capital gain. And so that is what the federal and state governments say, you generated income, we're going to tax part of that. So it's not the full $30 that you sold it for, because remember, you paid $20 a share for it. It's that $10, it's that gain that you made by taking your money, investing it in a capital asset. It gets a little more complicated when it comes to real estate, but it's the same principle. Whatever you paid for it, if you at a later date sell it for more than that, there's a gain involved. There's also depreciation in real estate. We don't want to get into that. Collectibles. If you purchase, say, gold or an antique or a painting or my favorite, classic automobiles or exotic cars, and you pay. Let's say I was reading the other day about some auctions out at Pebble Beach, and the high end of the car market is really picking up after the recession. And some of these Ferraris from the 60s are selling for $8, $9, $10 million again. So if you bought that Ferrari for $5 million and you sold it for 10, that $5 million, that's capital gains, okay? So that's what a capital gain is. Generally, a long-term capital gain is anything that you owned more than 1 year. A short-term capital gain is anything that you owed less than a year. Okay, so when you sell that, there arises what's called capital gains tax, and that's what we're going to talk about here today. So prior to January 1, 2013, there were two capital gains rates at the federal level. The 0%, meaning you could sell as items for a capital gain for no tax if your overall tax bracket was in the 10 or 15% tax bracket. And so what that means is you could go all the way up to somewhere around $60,000 or $70,000 of taxable income and owe no capital gains. Now that's a wonderful, wonderful benefit to people that are in those brackets. And you'd be surprised at how many people fall in that. Now, if your total income, including capital gains, so wages and capital gains and any other type of income, if your total income was above, and I don't have the figures right in front of me, but it was somewhere around $70,000 married, then your capital gains were taxed at 15%. Oh, here it is. For 2013, it's $72,500. Okay, so if you were below $72,500, your capital gains rate was 0. Above $72,500, if you were married, the capital gains rate was 15. We're coming up on our first break here. When we come back, we'll continue talking about how to successfully navigate the new capital gains maze. For All Things Money, I'm David Blain.